Now, let's proceed with the building blocks of accounting. Again, this is a video series on principles of accounting, and this is intended for those who are taking basic accounting courses or to those who just would like to learn about basic principles of accounting. So, I have posted the links of topics in the description below so you can follow. So, now, in accounting, we have this what we call GAAP or the generally accepted accounting principles, wherein it is where common sets of standards are generally accepted and universally practiced by all the business. And it is actually a responsibility of the FASB or the Financial Accounting Standards Board, as well as the SEC or SEC, or also known as the Securities and Exchange Commission. Many companies adopted the accounting standards issued by the International Accounting Standards Board or the IASB, and these standards are called International Financial Reporting Standards. Now, this is the basic accounting equation. So we have assets, liabilities, and owner's equity. So the equation is assets should be equal to liabilities and owner's equity. So we will be defining each of these. But if you look at the equation, liabilities appear before owner's equity because they are paid first before the business is liquidated. So just a quick definition of an asset. These are the resources that the business own, while liabilities are claims against assets. So what remains are the owner's equity. So the basic accounting equation applies to all economic entities regardless of size, nature of business, or forms of businesses. May it be sole proprietorship, partnership, corporation, cooperative. So all of these businesses apply the basic accounting equation. And this accounting equation provides the underlying framework for recording and summarizing the economic events of a business enterprise. So let's look at again what are assets. So again, assets are resources owned by the business. So meaning if these are the resources owned by the business, they have the capacity to provide future services or benefits to the entities that use them. So let me give you some example first. So we have cash, land, building, equipment, accounts receivable. So in terms of cash, when a business has cash, meaning this cash can be used later on for purchase of supplies, payment of salaries to employees, something like that. And for liabilities, these are claims against asset. So in simple terms, these are existing debts and obligations that a business must pay. So example, we have accounts payable. So example, you purchased supplies and then you promise to pay it on a later date, so you have accounts payable. Then when you signed a note, you have notes payable, and you also have wages payable. Now, for owner's equity, these are ownership claim on total assets. And in the equation, it is equal to total assets minus total liabilities. Why? Because it is what remains after deducting the total liabilities from your total assets. That is why it's also called as the residual amount. So in a proprietorship business, this owner's equity account is increased by investments and revenues, while owner's equity are decreased by owner's drawing and expenses. So let's look at each of these. So those investments, revenues, capital, drawings are your principal sources of equity. Let's start with investments and drawings. So investments are assets put into the business by the owner. So you invest for cash. So that increases the owner's equity. Now, for drawings, or also known as withdrawals of owners during the accounting period, so when an owner withdraw money or other assets, meaning the owner's equity of the business decreased. So we have to remember that investments increase owner's equity and drawings decreases owner's equity because we will be dealing with that later on in our transaction analysis. Now, how about revenues and expenses? So revenues are results from business activities entered into for the purpose of earning income. Like, let's say, for example, service revenue, you rendered service. You have sales revenue, you receive money from sales of your merchandise. You receive money from the rent. So that is rental income or rent revenue. So that increases your owner's equity, right? So for expenses, it results from operating the business. So these are cost of assets consumed or services used by the business in the process of earning revenue. So it represents actual or expected cash flows, specifically outflows, because these are payments by the business. And examples of these are your wages expense. You paid for the salaries of your employees. Utilities expense, like your payment for electricity, water, payment for the rent, that is rent expense. So that decreases our owner's equity. So remember those four accounts. These are your principal sources of equity. And again, these have effect, which either increase or can decrease your owner's equity. So let's look at this illustration for us to absorb these principal sources of equity. So investments by the owner increases owner's equity, and that is together with your revenues. Now, when you withdraw from your business, that decreases your owner's equity. And another is that when you spend something, that decreases your owner's equity. Now, these are our building blocks: your assets, liabilities, and owner's equity. Now, how are we going to use these building blocks? So in accounting, the first process, remember, is identifying, right? So what are we going to identify? Transactions, specifically business transactions. So these are economic events of the enterprise that are being recorded. So it may be external or internal transactions. So external transactions happen between company and some outside party, while internal transactions occur entirely within the company. So a company may carry on many activities that do not themselves represent business transactions. So that is why in transaction analysis, we have to analyze carefully, because some of these activities may lead to a business transaction, and each transaction must be analyzed in terms of its effect on the components of the accounting equation. So we have to identify the specific item affected and the amount of change in every transaction that we are going to analyze. Let's say, for example, if an individual asset is increased, like you purchase supplies, you purchase equipment for your business, there must be a corresponding decrease in another asset. Like you pulled out cash out from your business, so your cash decreased. Remember, cash is an asset. Or it could also be a specific liability is being increased. Like you purchased that supplies, but you did not pay it, so therefore you have an accounts payable. And remember, liability account is your accounts payable. Or it could also be that there is an increase in your owner's equity. So this whole thing sums up the transaction analysis, wherein here we have to analyze carefully every transaction, and the ability to analyze transactions in terms of the basic accounting equation is very essential for an understanding of accounting. So I made these three basic questions or key questions in transaction analysis, and I hope that you will take note of this. The first thing that we need to ask is that what specific account is affected? If it's asset, what particular asset? If it's liability, what particular liability? Second one is that what is the effect? What is the effect to your cash? Let's say, for example, is it increased or decreased? What is the effect to your liability? And the third question you need to ask is that how much is the amount of change? So if your asset cash increased, how much? Let's say 5,000. So how much also is the decrease in another account? So you have to take note of that. So let me give you an example. So these are just a series of three transactions. but I made a separate video of all this transaction analysis, and I have posted the link on the description below. Okay, so sample problem. Angel Oxin decides to open a computer programming service. And on April 1, 2014, she invests 15,000 cash in the business, which she names SoftBite. So take note of the three questions. What accounts are affected? So in this particular transaction, what accounts are affected? So when Angel Oxin decides to open a computer programming service, she invests cash. So meaning she put cash into the business. And that is considered as her capital. So meaning we have asset and owner's equity account. So what specific accounts are affected? We have asset, cash, and owner's equity, Locsin capital. So in accounting, we write that way, the surname and the word capital. Now the second question is, what is the effect to this account? So when you invest into a business, you put that cash into your business, meaning your asset increase. Now, for your owner's equity account, when you put that into your capital, so investments, remember, increase owner's equity. So therefore, both of your asset cash and owner's equity increase. Now, the third question is, how much is the effect? So, of course, you have that 15,000. So both increase by 15,000. Now, let's proceed with our second transaction. SoftBite purchases computer equipment for 7,000 cash. So the first question that we need to ask, what are the accounts affected? We have your equipment, right? And cash. So both of these are your asset. So you have asset, cash, and asset equipment. Now what happened to your cash? So when you purchased, that equipment is already yours. So your equipment increased by 7,000. But you pulled out that cash from your business, so your cash decreased. So therefore, your cash decreased and your equipment increased. So how much is the effect? So your cash decreased by 7,000, which is the amount that you paid for that equipment. And since that equipment is already yours, so meaning your equipment amount increased by 7,000. So that is what I said a while ago, that in every transaction, when you spend cash, that decreased, but there must also be a corresponding increase in another asset or another liability account or owner's equity account. So that is the end of our first topic. And on the next video, we will be talking about the recording process.